Our featured guest today, Christopher Toomey, is with Morgan Stanley Private Wealth. He's back with us. Good to see you again, Chris.
Hi, Scott. Thanks for having me again.
I'd like to play off the DoorDash news if we could. Just simply, you're talking about a big-time valuation on a day where we're looking at downgrades to some of the most high-flying of growth tech stocks. Are we overheated? Are we looking at a big, giant bubble in one part of this market?
Well, look, I think if you look at equities in general, particularly on the S&P 500, about 90% of the index right now is trading at above its 200-day moving average. So it's probably a little bit overbought. But I think what's important is to understand why we're at this place. And I think it's really based upon two important factors. The first one being we're at a situation where we've got a very accommodative global monetary policy that's going to go out until 2023. So we think that's going to provide continued liquidity into the market and keep rates still at very low levels. And in addition to that, we've also got tremendous global fiscal stimulus coming into the economy. There's news with regards to Mnuchin and Pelosi coming together on a CARES 2.0 stimulus plan that we think is going to provide continued stimulus to the economy. And I think if you think about it, we're right now in a situation where we believe we're still in a V-shaped growth economy. And this is going to be synchronous across all major and emerging market economies. This is 12 out of the last 40 times we've seen this. It's been a very good outcome for markets. And we think that that type of conviction is going to continue to prop risk assets higher in these markets. So I think, yeah, we probably wouldn't be surprised if we see a pause right now. But I think our general view over the short and intermediate term is for continued outperformance.
So you agree then with your pal over at Morgan Stanley, Mike Wilson, who says almost identically, recoveries create rotations, right? We've seen this rotation into value stocks. But with those rotations now fully in gear, it may be time for a near-term pause. He says it's critical to be more selective rather than chasing, and he, like you, is certainly positive over the longer picture.
Yeah, absolutely. I mean, I think if you remember when I was back in September, we talked about the opportunity of value versus growth, and in particular in small caps. October, we saw markets pull back, I think with concern about a second wave of COVID, as well as concern about the outcome of the presidential election. And then we had a huge rally in November, and small caps now are up about 20% over that time period. And we saw value start to catch up to growth. And so that disparity between growth and value in large cap and small cap has now come to a more reasonable area. And now we probably want to be a lot more selective with regards to where we're putting capital in those cyclicals, in those value areas, because they have run a little bit.
It sounds, though, like you're all in on this V recovery and this economic resurgence once we can all get the vaccine and get back to whatever normal is going to look like on the other side. You're overweight cyclicals, industrials, energy, materials, financials, small caps, pretty much the whole gamut.
Yeah, I mean, I think the one place that we're not overweight is probably fixed income. I think if you look at where rates are right now, almost 80% of the global fixed income market yields less than 1%. The move in November has put credit spreads at all-time heights, all-time tights, whether you're looking at investment grade or high yield. So there isn't a tremendous amount of value in those areas of the market. And so we do see some real opportunity still in equities. And I think part of that conviction comes from, just looking at general companies right now. And generally speaking, they're in very good shape. PMIs continue to be very positive. And then if you look at the consumer, which makes up a large deal of the economy, even though unemployment's at 6.7%, we're still seeing personal income rising. We've got a savings rate above 13%. And I think a lot of this is being boosted because we've got a strong housing market. We just saw that mortgage rates are now at all-time lows, and the stock market's doing exceptionally well. So you throw that with the stimulus that we're seeing both from global monetary authorities as well as fiscal authorities, I think that's going to continue to push risk assets higher.